So trading is about having a edge, and we normally have a probabilistic edge when we're trading. And then it's about risk management. It's about defining your losses, making sure that your losses is as small as it can possibly be. And if that stock that you own 1,000 shares went down $1, then you would lose $1,000. So you're making or losing $1,000 for every 1 point, because that's how many shares you have here. Okay? And you could have a bunch of different other companies on, right? Just say in this example here, you got five. You have five different companies. So we'll see. All right, so let's jump. Let's talk about some basics really quickly, guys. And I'm gonna talk about some rights and obligations, basic contracts, and then we're gonna talk about some beta weighted delta. Okay. We went over this sheet a lot of times. If you've been on a webinar, this is not something that's new to you. This image on your screen. It's not new to you at all. But I want to point out that if you are a buyer, and please interrupt anytime. This is basics, but basics are important with options, everyone. If you don't have a solid foundation, it's going to come back and haunt you eventually. It's just like building you know, building a complex or high rise. If you don't have a solid foundation, it could come down, unfortunately. All right, so if you are a buyer of a call or a put, you have a right to do something. You have a right. And you either have a right to buy at a strike price if you're the call purchaser, or you have a right to sell if you are the put purchaser. You're paying monies, and that is your max potential loss, is what you're paying. And most of the time, if you're doing something that is a single call and a put, you're going to have at best a 50-50 shot. Only time when you're buying something that you can have a greater than a 50-50 shot is if you're buying a spread in the money, right? If you're buying a spread in the money, if you were on the call yesterday during the witching hour, similar to the put spread that I bought in the money on FedEx, it didn't work. It said I had a 61% chance of winning something, but it didn't say a 100% chance. So FedEx's FedEx's went up a lot after their earnings, and so we're gonna lose on that one. The defined amount of risk was okay with that being the potential loss of $150. That was the most we can lose on that trade. Okay? But that was a buying of a put spread. So the buying of a put spread, if you're the buyer, if it's a net debit, you have a right that supersedes your obligation. Because if you are the seller of an option, then you have an obligation. And I always like to point out that the word obligation has a negative connotation to it. But in the option world, it's not a negative. It's not a negative to have an obligation. If you're the seller of a call, you have an obligation to sell shares. You have the obligation to sell shares at a strike price if the buyer exercises their right. The seller of the put has an obligation to purchase shares at a strike price if the buyer exercises their right to sell. Right? It's always two sides of this coin with options. You're always going to have a buyer and you're always going to have a seller. If you're the seller, you have an obligation, and your obligation could be, once again, either to sell or to buy. But if you're the seller of an option, you're representing the casino. You're representing the casino. And let me elaborate on that a little bit more. Now, at a casino, they have slot machines, they have blackjack, they have roulette wheel, they have all these different games, right? And they have some type of edge, sometimes very, very small edge on some of their games. But even if they had a small edge, let's say a 1% edge, some of their games are actually less than that, but I just say they had a 1% edge. if they manage the losses at a high level and you play enough, they will win. They will come out on top with even just a 1% edge. And so casinos, they manage their risk by having stuff like table limits. Right? You can't bet, $5,000 at a $10 blackjack table. You just can't do it, right? Because they understand that you can win some hands. So they're not going to let you win a big dollar amount. They want you to continue to play. And the more you play based on the law of large numbers, they will win because they have the probabilities on their side. And if for some reason you're really excellent and you're going on a win streak, they're going to think eventually that you're cheating, or if you're not, it's still going to stop you from playing because they're about risk management. They have all these slot machines that's all over the place at a casino. And they know people are going to sit there and put, play that slot machine, keep pulling that lever, right? And the odds are very small that the person's going to win on those, but they're going to let some people win, right? So they're going to have little small jackpots, and then they're going to have these huge big jackpots. But they understand the risk. They know that, okay, they're gonna have a million. Just for example, they're gonna have a million people, play, give them money before they have a big winner, whatever the case may be. So for us as option sellers, if we have the odds on our side, and most of the time as a primary option seller, you have the odds on your side, right? We have the way we trade here at the Dorian Trader, we have usually at least an 85% chance of winning something at expiration. But that does not mean you're going to make money. It does not mean you're going to make money, because if you win 85% of the time, but that 15% of the time your losses are too big, they supersede the 85% gains, then you lose. So trading is about having a edge, and we normally have a probabilistic edge when we're trading. And then it's about risk management. It's about defining your losses, making sure that your losses is as small as it can possibly be to keep the game going. So we were doing these earnings plays, and I said, okay, I'm going to allocate a certain amount of money on earnings plays this year, from primarily engagement and for learning purposes, and to see if we can figure out a way to consistently make money on earnings plays that expire that week, right? Like the one we did last night in FedEx. It expires today, so we don't have any more time for FedEx to fall later in the week. Right? We don't have any more time. It's either we're basically gonna lose a day or win a day, and to this point, we're gonna lose the day on that. The last time we did one on Ultra Broody and Adobe. We won on both of those. This one we're gonna lose. And if we add it all up over the last 3 trades, there's basically been a small net positive. But overall, since I've been doing these earnings plays this year, it's been a net negative. I think I was down 650 coming into the day. I'm going to be down, what is it, 800, because you add 150 to 650. I'm going to be down $800 on the year so far, and it's not even the end of the quarter. One of those was a really big loss, and that's the risk management part. Right? So going forward, I'm most likely not going to structure something that has more than $150 loss. But you have rights and you have obligations. I'd rather have an obligation in the option world if I had to have a primary strategy, and that's why we're primary option sellers. Right? So I just want to manage the times that we lose. This is an example from Andrea. She gave us this example. I decided to have Danielle throw it on a PowerPoint slide for me, because I wanted you guys to really understand rights and obligations if you don't to this point. Right? The insurance company has an obligation to make you whole if you get into a car accident and you have full coverage, let's just say. They have an obligation to make you whole. If your car is completely totaled, they have an obligation to make you whole. You have a right to get your car fixed or get some type of check to make you whole for your car being totaled. You have that right. In the housing market, and this is an example from the UK, but we have this same concept here in the United States, is that in real estate, you can have a contract on a home in which the buyer is given the right to buy. Let's say a year down the road at a set price. Right? That sounds like a strike price to me, right? Sounds like an option to me so far. The buyer has the right of first refusal on whether they want to purchase the home or not. That first refusal, because they have this option. On the opposite side of the contract, the seller is obligated by the contract to sell to the buyer should the buyer wish to exercise their right. For that right, the person who has a right, they're paying something for that right. They're paying for that they're paying for that contract, because this is a contract, everyone. They're paying for it. So the seller is not going to have an obligation, not going to be obligated to something without being compensated. So the buyer can walk away from the contract, the seller cannot. It's known as an options contract. Right? They've been doing option contracts for a long time. Right? You know, some people date back option contracts as over 1,000 years ago. So this is how you want to understand your right and obligations of when you're dealing with options. Any questions to this point? Let's talk about delta, and let's talk about it based on being beta weighted. So let's start off by saying that delta based on a directional risk gauge. It measures, because delta measures two things, your directional risk and your probability of success. Right now, we're going to just be talking about your directional risk. Okay. So the easiest way to kind of start thinking about delta is to think about it as a share first. So if you had one share, you're going to have one delta. And I just talk about positive. You're not short a share right now. You're long a share. If you had 10 shares, then you have 10 deltas. If you had 100 shares, you have 100 deltas. And if you had 1,000 shares, that's going to equal 1,000 deltas, individual deltas for that stock. I just say the stock is X, Y, Z for right now. So delta measures how much you will make or lose based on a 1-point move. So if that stock went up $1, you would make 1,000 in this case. And if that stock that you own 1,000 shares went down $1, then you would lose $1,000. So you're making or losing $1,000 for every 1 point, because that's how many shares you have here. Okay? And you could have a bunch of different other companies on, right? Let's just say in this example here, you got 5. You have 5 different companies. The company 1 is this one we just showing right now, and you have 1,000 shares, 1K. Company 2, you have 500 shares. Company 3, you have 50 shares. Company 4, you have 100 shares. And then company 5, so you got 25 shares. So you have all these different companies. And so you have 1,000 deltas in the first one, 500 deltas in the second one, 50 deltas in the third one, 100 deltas in the fourth one, and 25 deltas in the fifth company that you have. When you beta weight something, when you beta weight your portfolio, what you're trying to do is make it equivalent to having just one thing on. It's as if you just had this top one on here, and you can clearly understand your deltas here. You're either going to make $1, or excuse me, $1,000 every time it goes up $1, or you're going to lose $1,000 every time it goes down $1. But when you have this scenario, when you have all these different stocks and you have different shares on it, so in return different deltas, you don't really know how your portfolio is going to react. Theoretically, you don't know, right? You don't really have a gauge on how it's going to react because you have so many different things on. But if you beta weight it, if you made it all equivalent to the SPX, that's what we do here at the Dorian Trader. You can do the SPY as well, but we do the SPX. So it's going to give you, it's going to make it seem like you just have the SPX on it again. So as if you just had one thing on. So if you beta weight it all, and I just say it comes out with a number that says you're plus 15 deltas of the SPX. So what that means is that every time the SPX goes up $1, you're going to theoretically make $15. Every time it goes down $1, you're going to theoretically lose $15. You're beta weighted to the SPX. Most professionals beta weight their portfolio to the broad market, which is considered the S&P 500, and so it's a benchmark. You can gauge your success based on that benchmark, that index. And so this is telling you that if this is your portfolio, you're long 15 SPX deltas, and that if the SPX is going up, you're most likely making money. If the SPX is going down, you're most likely losing money. But it's not one for one sometime, because you do have this other Greek called theta, that the theta could be outpacing the delta directional move, and that happens sometime.